How to start investing into the share market. That is what we're going to be breaking down in today's video. I get a number of questions from beginner investors, which is awesome. It's fantastic to see you starting out on your investing journey. But there's a few things that we need to consider before we start investing into the stock market. So that is what we're going to break down in today's video. First things first though, before we start investing into the equity market or share market, stock market, it's all the same thing, is you must pay down your high interest debt. I know it's not very exciting. I know, especially if you're just starting out, you want to, you've read a book maybe, or some of your friends are buying shares and you want to be part of the action. You just want to jump straight in, but you're best off to pay down any high interest debt you have. This is things such as credit cards or car payments or anything that's sort of got an interest rate of north of 10%. The reason for this is you're going to be probably hard pushed to beat that in the stock market. I mean, you may get lucky if you speculate on a stock and it goes up very quickly in a short space of time, but generally over the long run, this is not a good strategy. So I definitely recommend paying down that debt. And whilst you're paying down that debt, you can start learning more about investing. Start reading a few books. I've got a few books in the description below, some of my favorite investing books, which I highly recommend. So definitely check those out. So like I said, while you're paying down that debt, you can start learning a bit more about investing. So by the time that you've finished paying down that debt, you're ready to go. You've got a bit more of an understanding, or maybe a bit more of an investing strategy that you may want to implement when you start investing. So that's the first little disclaimer before we get into it. Okay, so now let's just establish what exactly a share or a stock is. Think of it as that you're buying a part ownership within that business, okay? You are now a part owner of that business. So with that business, you've got revenue that gets generated from that business. There's a lot of expenses and outgoings. All that has happened, and hopefully at the end of the day, there's still some profit left over for you as a shareholder, and this can either get put back into the business to generate more profits, or in some cases it gets returned to shareholders as a dividend, or some cases the company may even look at buying back some of the stock as well, which is great for us as shareholders. So that's the first things first. You are a part owner of business. Think of it that way. And ideally, we want to be buying these businesses below what they're intrinsically worth when they're on sale. So we're not going to be breaking that down in today's video, but I have made a few other videos around that. So definitely check those out if you're interested there. So that's it. So pay down your high interest debt. Think of owning a share as owning a piece of a business. That's the next key step. Now, there's a couple of different ways we can go with this. You can either invest into individual companies, or you can invest into what's known as an index fund or an ETF, an exchange traded fund. This is a great option, especially if you're just starting out on your investing journey. Reason being, you're getting great diversification across an entire market. And this can be no matter wherever you are in the world, Australia, New Zealand, America, Canada. There's thousands of different ETFs out there. Some have quite attractive fees. So that's one thing you want to sort of focus on when you're looking at investing into an ETF, is the fees that they charge. Now look, if you're here from Australia, majority of my audience is from Australia, a great option for you to consider would be the Vanguard VAS ETF. So this tracks the top 300 companies on the Australian ASX. So you're a part owner of the top 300 companies. You're a very small sliver of that pie, but you will be a part owner. And this is the big companies that you're probably all well aware of. All the miners, the banks, Telstra. You'll be a part owner of all of that. And as the market goes up over the long term, you will be riding that. This is a great hands-off, passive approach, especially if you don't have a lot of time, you're busy with work, your family, everything like that. This is a great option for you to consider. And it could be, especially if you're just starting out, definitely recommend looking into different ETFs. Vanguard have some of the cheapest ETFs out there, also BlackRock as well. So definitely start with those two, and then you can start venturing out a bit from there. So that's a great sort of first option if you're looking at investing into the equity markets. The last option we're going to talk about today is investing into individual companies. Now this is the option that a lot of people want to jump straight into straight away. But over the long term, 80% of people can't beat the index. That is like what I was talking about in the previous example about investing into the index. 80% of people can't beat that index. So definitely just think about that before you start investing into individual companies. And you can use a combination of both. You can invest into ETFs predominantly, and then maybe have a few shares of individual companies that you're investing into as well. There's a few things you want to consider though before you start investing into individual companies. First being, try and invest into companies that are easy to understand. Maybe you work in this sector, you have a bit more of an insight or knowledge about that particular sector, which gives you a slight edge over a lot of different other investors. So definitely invest within your circle of competence. And over time, as you become a better investor, that circle will grow eventually. But just when you're starting out, definitely look at investing into companies that you have a deeper understanding of. You want to invest for the long term as well. Don't get caught up in the day-to-day movements of stock prices. Like I said earlier, I get a lot of questions like, the stock price went up 10%, should I sell? Unless something's fundamentally changed with the business, then definitely just look at holding for the long term. If you're investing into a company, think about it that you want to own this company for 10 years. Don't think about it you want to own it for 10 minutes. Definitely invest with a long-term approach. Try not to get caught up within the day-to-day movements of the company that you've invested in. I get a lot of questions around, oh, well done, the stock went up, or oh, the stock went down, you're an idiot. So definitely think about this, okay? I know, especially when you're starting out, it's easy to invest, and then the next day the stock drops 5%. You think, oh, I'll panic, and then you sell out of the company. So you've got to think around the psychology of investing as well. Definitely it takes the right sort of temperament to invest into individual companies. I have done a video where I break down the psychology of investing, so I definitely recommend checking that out if you want to sort of learn a bit more about that and thinking around the temperament you need to invest into individual companies. Definitely recommend the book as well, Psychology of Money. Definitely a good beginner book, especially if you're just starting out on your investing journey as well. So there's that. We do have a slight edge over these institutional investors, the hedge fund managers, is that retail investors like me and you, we have we're a lot more smaller, we're managing a lot less capital, so we're not moving the market when we invest into a company, unless you're managing billions of dollars where you're moving the market, which if you're watching this video, I'm pretty sure you're not managing billions of dollars. So that's a slight edge. We can buy in and out of companies a lot quicker. Within seconds, we can be in and out of a position, which is a good thing. We can use this as on our side, but also a bad thing, because people can buy and sell. If they're having a bad day, they had a fight with their missus or something, they can sell the stocks or whatever. So definitely it is a pro and a con there. So definitely another thing to consider. Also, we don't have pressure from outside investors that we have to perform. We can just sit on our hands and not do anything. Buy into a company, hold it for 10 years and let it run its course. We don't have to be seen to be actively buying and selling on a daily basis. There's a lot of noise out there saying, oh, we should be buying, should be selling, what we should be buying today, what should we be selling tomorrow. Try not to get caught up in any of that. You just want to be buying good long-term businesses that have a good runway for growth. And ideally you want to be buying them below what they're intrinsically worth. This is a little bit more of a harder thing to wrap your head around, especially when you're just starting out on your investing journey. And we're not going to be breaking that down in great detail, but we want to be buying into these great businesses when they go on sale. Like we saw last year in the big COVID sell-off, a lot of good businesses went on sale only for a very short period of time, and then the market ticked straight back up, and it's been a long bull run since then. So, every once in a while we get served up some of these great opportunities to buy into some of these good companies. So just a quick recap before we move on to the next topic. So we've established that you need to pay down your high interest debt before you look at investing. We know what now a share or a stock is. It's a part owner of a company. Then there's a couple of different options like we explained. You can either invest in the entire market or you can start picking individual companies. But like I said, it's a lot more active, hands-on approach investing into individual companies. Lastly, we need to open up a brokerage account in order to buy these positions, whether that's in the ETFs or within individual companies. When it comes to opening up a brokerage account, if you're here in Australia, I recommend just starting off opening a brokerage account with the bank that you currently bank with. The big four banks here in Australia, that's been Westpac, ANZ, CommBank and NAB, all offer share brokerage platforms. And they're all very much similar, and they're very similar costs to buy and sell shares across these different platforms. I have made another video where I break down different brokerage accounts, so I definitely recommend checking that out if you want different brokerage accounts to consider. So we need to open up one of these brokerage accounts in order to buy and sell equities. And then I've also made a video where I break down how to buy and sell equities, because it can be a little bit confronting, especially when you're going through the different menus and you're buying your first shares. So I've also made another video that breaks that down, so I definitely recommend checking that out as well, where I break down how to buy and sell your first shares in the Australian market. But this can be used across any different market as well. So the last thing we're going to cover off on today is, now that you're starting to invest into the equity markets, whether that's through exchange traded funds, index funds, or buying individual companies, you want to track the performance of your portfolio. Now, the best tool that I've found to do this is a company called Sharesight. I'll leave a link in the description below so you guys can go through and check it out after this video if you like. But a very basic overview of this platform is, it's a great way to keep tabs on your dividends, your capital gains, the currency differences, especially if you're looking at investing into the US market or whatever other market you're looking at investing in. It keeps track of all this in one nice, neat package. And depending on the brokerage account that you've signed up with, you can automatically integrate your shares that you've been buying and selling straight into this platform, so you don't have to do very little. It all sort of keeps track of everything for you in one nice, neat little package. And it is free to have 10 positions within this portfolio as well. Once you go over that 10 positions, then there is a couple of different paid options as well, which are very affordable. And the biggest thing about all of this is it makes it so much easier come tax time. Now that you're starting to invest into different individual companies, there's a good chance you may be buying into companies that pay dividends, so you'll have to pay tax on those dividends, even if you get those dividends reinvested. Sharesight takes care of everything. Just prints off a report come tax time, send that straight through to your accountant, and it takes out a lot of the niggly stuff that you've got to sort of keep tabs on. So I highly recommend signing up to Sharesight as well. So guys, that's just a very high level overview of things that you may want to consider before you start investing into the stock market. Look, if you've got any questions on anything I covered off today, drop it in the comments below and I'll do my best to help you out and may make a follow-up video if there's anything there that I was a bit unclear of. I know we covered off on a lot of things, but like I said earlier on, congratulations on starting on your investing journey. I think it's awesome and I'm glad that I can be a small part of your investing journey, especially when you're starting out. Look, there's so much noise out there and so many different things you need to learn and consider. And it's a lifelong journey as well, guys. You're not going to learn investing in half a day. This, honestly, if you're just starting out, this is something that, especially if you're wanting to be a lot more active, hands-on investing into individual companies, this is something that is a lifelong practice. Even myself today, I've been investing for a number of years. I'm still constantly reading, constantly learning every day, and my investing strategy is evolving over time, which it will for you as well. So definitely a few different things to consider there. Anyway, guys, we're going to wrap it up there for today's video. Like I said, any questions or any dramas, drop in the comments below and I'll do my best to get back to you. Till next time, we'll catch you in the next video. Cheers, guys.